All right, guys, super excited to bring you May's Investment Committee webinar. I'm Bobby Mascia. I've got my partner, Jordan Kaufman, our CIO, on the line. We've got Brandon Sisk and Sean Cole to help put some color around what's been going on in the news and the headlines. And we're excited to kick this off for you this month. All right, Sean, let's get her going.
Yeah, absolutely. So just want to start by giving you guys a market update. It has been a crazy last 2 months in the market. So just wanted to start by going over what happened in April again. This is directly from our commentary at the end of April from Jordan. April 2nd, there were sweeping tariffs and the market was down. S&P was down 14% off of that news, Liberation Day. From April 9th, there was a 90-day pause on these tariffs, which led to a single day 10% rally in the S&P 500. Between April 10th and April 21st, there was some renewed uncertainty and Fed concerns. The S&P fell another 6.5%. And since then, the market has rallied tremendously, up about 15 to 20% since that April 21st date. So it has really been a roller coaster in the market since that Liberation Day. And we've seen a tremendous recovery. If we look at some of these major indices in the last 1 month, the S&P 500 is up about 13%. The NASDAQ 100, which is a little bit more technology growth heavy, is up 17%. And some of these other major indices seeing some great returns still too. The Dow Jones up about 10, International's up about 8%, and the small cap heavy Russell 2000's up about 12%. What have we seen so far in terms of some of the individual sectors, Brandon, over the last month and year to date?
Yeah, so similar to the points you just made, over the last month, we've really seen a really strong rebound in things like technology and consumer discretionary. And where you're seeing some of the lagging behind sectors are from consumer staples and healthcare. And if you remember 2 months ago, we had another sector update, and it was kind of flipped, showing more of a defensive or bear market where healthcare, consumer staples were kind of at the top of the list from a year-to-date perspective and a 1 month. But we've really seen that switch where, the technology, consumer discretionary has really become, rebounded well and having a little bit more risk on. And I think you can also see that with, Bitcoin's numbers too, of, really rebounding well, being up 13.3% year to date, and over the last month being up, 25%. So you can kind of see where the funds are, flowing towards, and kind of that risk on behavior where before you were seeing a lot more defensive at the beginning of April, end of March, where the original tariffs were being announced.
Yep. Yeah, as you mentioned, these three sectors at the bottom here, defensive sectors tend to do well in recessionary conditions. So as you mentioned in our last webinar, when recession chances were skyrocketing, those sectors really did well. And since then, the market has really just shrugged that off, and technology has emerged as the leader over the last month.
This really, I mean, you're just looking at this, it's just such a wow. Um, it, it's it's very, very interesting to kind of take in. And something that, just from a way to kind of share the experience that I've had in the market and how to think about it is the market hears multiple points of news. It hears good news, it hears bad news, and it tends to focus on one or the other in different environments. And in a bear market environment or a market that normally is trending down, good news is overlooked, bad news is focused on. And vice versa, in a strong market, bad news gets kind of shrugged off and good news is highlighted and celebrated. And I think if you look at that, I think for April 2nd to April 9th, it was really hard to find any good news. And then April 9th, when the tariffs were delayed, the market really celebrated that news. And pretty much from that point on, good news got a huge rally and bad news got only a minor sell-off, like when the Federal Reserve, expressed major concerns and expectations around cutting really declined. So I think, the biggest thing that this page, as you said, cyclical sector is doing very well. It really seems that the market right now only has ears for good news. And when they hear bad news, even with all the uncertainty kind of floating about, you could take that uncertainty both ways. You know, if you're driving through the fog, you can either hit the brakes and slow down, make sure you don't hit anything and be a little bit more cautious, or you can go full, cold trickle. For those who know Days of Thunder, you just smash on the gas and, try to just go through as if nothing's going to be in your way. So seems right now the market's gone full cold trickle. Does that make sense, Bobby? Do you like that analogy?
I love that analogy. One of the best movies of all time. But it is interesting, the laundry list of things that were major concerns, global impact concerns that have, to your point, just kind of been thrown into the back seat. And now we're just, peering through the windshield and hoping not to hit something. So hopefully there'll be some good news that'll continue to kind of follow through and keep this market moving in the forward direction. But we always know that there's, until things are settled, there's still some uncertainty, and we just have to make sure we keep our antenna up for those uncertain moments.
Mhm. Yeah, looking at the 10-year Treasury rate, that's sitting at about 4.4%. It started the year at 4.6%, and we've recently seen a little bit of a jump in that rate, coinciding with Moody's downgrading U.S. credit from AAA to AA plus. They're citing concerns over the nation's $36 million deficit or trillion-dollar debt pile. And we've also seen the US dollar year to date is down about 7%. As of our last webinar, that was down 9%. So we've seen the S&P and the US markets really rally over the last month. The US dollar has not seen that same rally. And I think that just goes to the shaken confidence that international countries and investors still have around the US with just all the uncertainty that's happened over the last couple of months.
Well, we got downgraded.
Yeah. Over the weekend, yep.
Yeah, and that's, one of the things with the budget proposal that's now lurking around, and by some estimates, it ultimately will increase the deficit with the proposed tax cuts and some additional spending. There's some cuts in spending on non-defensive sectors, but there's increases in border security and defense spending. This is kind of the S&P has downgraded U.S. debt. It's not the first time it's happened. I think, it's always kind of done as a way to just and it normally happens during budget discussions, which are going to add to the deficit. So this is not something I think that comes as a big shock. And I think the budget was always expected to be slightly deficit increasing. But I think, you guys have the Federal Reserve interest rate cut here and the probability of June. And if you look at all the probabilities, they've kind of come down from where they were at the beginning of the year with the greater uncertainty and the fact that the Fed's been data dependent. And that's really kind of an important factor. As we were going into this year, and even if you go back to the commentary that we put together at the turn of the year for the first quarter, one of the things that we talked about as being a big positive for the year was the Federal Reserve cutting interest rates. And that, as the economy, as inflation kind of came down, and as the economy potentially slowed a bit, that the Fed would add a little bit of gasoline to that by cutting interest rates. And now with the tariffs, with creating a little bit of uncertainty around where prices go, Walmart, recently announced that they would be raising prices because of the tariffs, and they would try not to, and that's kind of caused a little bit of a spout between them and the administration. But really puts the Federal Reserve in a very unclear position, because I think they had a playbook for what they thought was going to happen, and the fiscal policy's really thrown that up into the air. So they're leaning in the we're not going to do as much as we said direction, because that's kind of what the Fed does. When interest rates, they were slow to raise interest rates as they saw inflation ticking up, calling it transitory. They were a little bit hesitant to start taking interest rates down when it was clear inflation was coming down. And now, it's really anyone's guess what's going to happen. So I don't think that it's crazy to think that they're going to be on hold longer than expected at the beginning of the year. What do you guys think?
Well, I got a question for you. When you start to think about just the dislocation in between, let's call it political math and real math, and then also the dislocation between our deficit and the Fed's responsibility to, or lack, they don't have any responsibility to manage the interest rates around our debt. What do you, how do you think that the market's going to continue to digest this over the next year or so as we continue to kind of muddle through these budget talks? And, to your point, we're always increasing the budget. It's just a matter of, are we increasing it less than we should be?
Yeah, tough to say. It's still the budget bill is still in negotiation. There's a lot of Republicans which have felt that, we're not doing enough to cut the deficit. So that's those negotiations are very much live. The treasuries, it's really been interesting watching the treasury market. I think the expectation is that longer term rates were supposed to go higher. If you look historically, they're not way out of line. So you would have to have a really, really strong opinion about what the future holds to call the treasury yield right now as incorrect. There are some people out there saying it one way or the other. Some people think it should be a lot higher. Some people think it should be a lot lower. I personally take a more humble approach of seems like it's in a decent spot to me, and it could go either way. So I don't, we'll see, have to see how things go. And I think there's too many things at play. I don't know anyone who's made a successful career out of predicting where the treasury yield is going to go. But I think, as we always kind of say, you stay observant, you keep on watching it. If it starts breaking out of a range, and the 30-year has started to move up and break to the upside. So it makes me kind of feel like I'd be more concerned about interest rates rising than dropping. But we'll have to see. The 10-year kind of has a little bit more liquidity and trades a little bit more based on near term.
It's just wacky because you think about, our deficit, you think about the tax breaks, you think about the potential impact on tariffs, which is essentially just a tax on us in a different way. There's all of these interesting, let's call them headline approaches on how to handle this deficit. Add to the fact that we have this compounding interest rate that as it continues to go up, it's impacting the deficit. And I'm curious to see how this all unfolds.
Yeah.
I
Coming off
think that dollar, the dollar's telling you how it unfolds.
We're coming off an April CPI number of 2.3% as well. That's about as tame as you could have expected for April CPI. But as you said, Jordan, with the Fed being so data dependent, you can't really predict how the tariffs are going to play into future inflation numbers. So I think we have to see how CPI looks for May, June, before really knowing how the Fed is going to react. Even though there's been pauses on some of these tariffs, there's still a 10% sweeping tariff all over, and China still has a 30% tariff on it. So even though it seems like there's been a pause, the tariffs are still in effect, and we'll see how that affects CPI numbers going forward.
Yeah, but you raise a good point, Sean. I think the economic data has been good. If you just look at it fully objective, the economic data that we've received from the beginning of the year, I know the GDP print was a little bit weird. I think that can kind of be a little bit ignored because imports was so high and imports get subtracted out. So it looked probably worse than what the reality is. But so far, the economy's held up really, really well. And maybe that's what the market's focused most on, is how well the economy has kind of taken the punches of fiscal uncertainty and supply chains and all those other things. I think the question is, are those punches going to keep coming? And because as you said, the tariffs were paused, but they technically come back in a little over 50 days, or at least negotiations have to happen. And even over the weekend, the administration was like, we're just sending letters to people and telling them how it's going to be. We're not really going through the negotiation act. We're just kind of like, here's what you get because there's too many countries we need to make deals with. We'll see how that all works, and we'll see how much is missed. It certainly seems that not all the details are being scanned through as we recreate this trade policy with all of our trading partners.
There's also too much, right? Because you also have people who are front loading all their inventory that are buying in the anticipation that tariffs are going to go up, and that impacts those numbers as well. So it's an interesting space, and I feel like we've been saying this a couple of times over the past couple of years. Like we're in an interesting space. Um, to your point before, this is really about observing what's going on and trying to make intellectual moves around other people's investments and dollars, so that this way we're not getting caught with our, with our pants down, but also not trying to be too smart to where we're trying to over forecast what's going to happen in the market because we all know that the wind changes directions very quickly in this environment, and let's just be smart and prudent.
Mhm.
News.
Yeah, taking a look at some of the recent news stories. I think
Maybe we should get like the SNL news theme. Like we should get some sort of theme that rolls into this
I
next
like
segment.
that.
I could
That's a
get
Next,
good
down with that.
little jingle. Yeah, I think definitely want to talk about the market rebound. We touched on it a little bit on the first slide, but just the resilience of the market over the last month has been tremendous. From the S&P being down 15% to now being positive 1.5% on the year. A pretty big V-shaped recovery, almost similar to what we saw during like COVID, just in how quickly the market bounced back. I think there's still a potential for volatility to come. Still a lot of uncertainty out there, but just from what we've seen in that recovery, pretty tremendous. So since April 7th, the S&P is up about 16%, and like I said, into positive territory. The Magnificent Seven has really led the charge since market lows. So if you look at those seven big stocks, Google, Amazon, Nvidia, Tesla, those are up about 27% since that bottom, whereas the S&P is up 16% since that bottom. So those stocks have carried the load since that April 7th date in helping the market recover. Um, and it's just been interesting because those were some of the laggards before April 7th, and since that date have really turned it around and helped bring the market back up.
And we should mention that earnings were announced during that period of time. A lot of news was announced on a continued investment in AI infrastructure and things like that. So I think the market that helped the market unfocused from the short term of tariffs and kind of a little bit of mania inside of Washington and refocus back on a longer term theme of productivity gains and benefits from kind of this next revolution in artificial intelligence. Um, that's kind of an important point, and I think I just want to sit on that and marinate for 1 second. We are big believers that if you focus your investment strategies on trying to figure out what Washington's going to do, it's very, very hard because it's a little bit ping-pongy, and depending on who's in office and what happens in midterms, things change very quickly. Whereas if you kind of focus on what's happening in the American corporate world and corporate profit growth and the margins companies are making, revenue growth, kind of, the dynamics of that, that's been a pretty clear up and positive trend for a long time. So if you spend your time focusing there and not as much on the deficit and what's the dollar doing and what's Washington's new policies, if you've spent your time there, you've been whipsawing back and forth over probably the last 20 years. If you've spent a lot of your time focusing on what's really happening on the ground at, some of the big companies in the technology sector, you've probably taken a great ride up with this market over that period of time. So just always want to throw in that context. We believe that's where the real meat is on the plate, and the other stuff is just garnish and, usually gets swept to the side at some point. So, just something to always kind of remind people of.
Yeah, I think the market really latched on to some of those technology companies coming out with great earnings that are a little bit more isolated from the tariff news. Because there were a number of companies that were reporting earnings and mentioning those tariffs and how that could impact their future guidance. But a lot of investors, I think, really just latched on to those Magnificent Seven that were coming out and continuing to have positive stories around artificial intelligence. And that really carried that market back up in the face of some of those other companies that are being more affected by tariffs. I feel like those technology companies ended up being the focus for a lot of people.
Yeah, I like how when you mentioned the Magnificent Seven, you only used four in your example and you left out Apple, Microsoft, and Meta. So I'm just wondering why you didn't give those companies any love, Sean, and we'll have to talk about that later.
Yeah, my apologies. It was just in essence of time.
Et al. ETAL et al.
Yeah. I mean, for the other news story, I mean, we touched upon this a lot with some of the lingering, uncertainty. What's the future for tariffs like? Obviously, there was the 90-day pause from, the initial tariffs, but, we still have that 10% baseline. And, even with the negotiations with China with the short-term pause for 90 days, we still have that 30% tariff on them. So, from an uncertainty perspective, it's really, how are these tariffs going to play out as these 90 days, come due? Is there going to be a change? Is it still going to be kind of just that 10% baseline or the 30% on Chinese goods? And then also, from the Fed perspective and, overall inflation, how does it really, affect everything? How much of it is coming from tariffs? And then also, what we touched upon during the last slide is really the Federal Reserve being data dependent. How can you really kind of like predict moving forward of when should we cut rates with kind of the uncertainty of how everything will play out, at the end of the 90 days? Is it still what he said it's going to be? Is it going to change? Are there any like exemptions for specific, goods or companies? So it's really hard to kind of predict. And, one of the things we always say is just, be more observant. You don't necessarily have to predict what's going to happen, but continue to watch as the market moves. Are certain things up more on up days or down more on down days? And really just taking a deeper dive instead of trying to predict how this is all going to play out in the future.
Yep. Love it.
Yeah, so in this last slide, basically what this table is showing is the annualized returns from 2003 to 2022 if you invested $10,000 in the S&P 500. And then it's showing what if you missed the 10 best days or the 20 best days during this time frame? How does that affect your overall returns? And it's basically saying, what if there was a decline and you panicked and then sold out and you missed one of the best days and then got back in the day after that? And you can see, that annualized return, if you were just fully invested during that time, is about 9.8%. And if you miss the 10 best days, it drops down to 5.6%. So you can really see the drastic difference of, trying to time the market of when the panic sets in and the emotion kind of gets the best of you and you might sell out because of, worries or concerns and you miss those best days. How does that affect, the overall return? And I think
I
the
think
big,
one- I
oh,
think one of the things from context though is, if we were to compare what it is that smart investing versus just blind investing is, the blind investment is you're doing it yourself and you're scared or you want to try to time the market, you pull out and you go to cash, and then it's like you miss the best day and you decide the next day to invest back into it because you feel the optimism. That's kind of what we're talking about. We're not talking about smart investing where we're rotating where dollars are being invested because we're not missing those days. We're still invested. So just, for clarity purposes, this is like, I'm scared. I'm going to go to cash. I can't lose anymore. And that's what we see a lot of people doing, not our clients, obviously, but a lot of people who are fearful, they kind of go, all right, pull the plug, we'll reevaluate later, as opposed to how do we reallocate? So go ahead. I'm sorry, Brent. I just want to make sure that that distinction was made.
no, yeah, I think that's a great point. And, that goes to timing the market. Like no one could have guessed that April 9th, the S&P, was going to be up around 9-10%, right? So how are you really supposed to guess those
Well,
good
let's
days?
go on the Twitter feed two hours before.
Well, all right, fair point. There may have been a little, trinkle of
Especially
hints in
in the
there,
room where
but
it happens. The room where it happens. The room where it happens. Sorry. That
yeah.
was my Hamilton reference.
Pretty outrageous, but to that point, you can't time the market of when there's going to be the best day or when there's going to be the worst day. And I think that really goes back to one, kind of having the solid investment strategy. What are you kind of observing? How are you managing that volatility? Is there a strategic shift that should be made? And I think also sticking to the financial plan that you've created. That way, it kind of takes some of the emotion out of it. You're not so worried about the specific down days and the headline news. You have the plan set. you know the specific, factors that have the biggest impact. Maybe it is a market decline, but maybe it's, another outside factor that's the biggest, has the biggest effect on your plan. So that's always a good way to kind of take some of the emotion out of it is, relying on that, having the conversations of what is the actual effect of this and how long is it going to last? I think that's another big thing is, the longevity of the declines, not necessarily, how large they are, how steep they are.
I
Well,
think
probably go ahead, Bobby.
I was going to say, I think one of the things that we've learned over markets is it's almost like you're getting ambushed, right? If you're thinking about a situation where you get ambushed, you're not ready for it. Maybe you anticipate that something's going to happen. You're not too sure when it's going to happen. Then all of a sudden you get it. You get attacked, and it's a matter of how do you set yourself up and go back onto the offense when it's time to get back onto the offense and rally the troops and be a little bit more, I guess, strategic in the forward movement because you got caught on your heels. I think we learned that it's okay if we're kind of sitting back and we're judging and we're waiting and we're watching. And we're also getting punched in the face a couple of times as the markets go down. We anticipate that. I think on the flip side, though, we look at when things start to turn in the positive direction, we're really ready to take advantage. And I think as investors, that's a smart way to approach it. Is you can't avoid getting punched in the face if you're going to be a fighter, but it's a matter of all right after you kind of understand the cadence and the way that the punches are getting thrown. How do you then move forward and win the fight? So I don't know. Does that analogy make sense, Jordan? Probably not as good as your Cole Trickle analogy, but
Taking the stairs down, the escalator up.
There you go. Yeah, I think one thing, and given Warren Buffett's recent announcement of his retirement and succession plan, it's probably worthwhile to give one of his quotes of be greedy when others are fearful and fearful when others are greedy. And I think that kind of goes to your point, Bobby. A lot of times what people do is they, kind of run away from markets or go to cash and they wait for the news to get better. But the reality is, it's almost when the news is at its absolute worst that you want to be putting dollars to work because by the time the news gets better, the market's already rallied and it's gone up. And vice versa, when you think, oh my God, almost nothing can happen, this market's completely Teflon, is exactly when, the rug gets pulled out from under you. So I think just always kind of coming with, as we say at the beginning, taking emotion out of investing. If you're feeling really, really good, then that's a time to kind of hesitate and go back to rational, logical thinking. And if you're feeling really, really scared, again, that's a time to take yourself out of that, go back to rational, logical thinking, because usually whatever your emotions are telling you to do, the opposite's probably the smarter thing. And just kind of always being at least cognizant of that. So you factor it into, how you approach some of your things, because behavior does play a part in this. Psychology does play a part. And we're always trying to counter the human emotions because those are usually the ones that don't end up winning the day.
Yep. I think that's all we got.
It's a
all
beautiful
right, guys.
thing.
Well, appreciate everybody's input here. If you have any questions, as usual, we are available, whether it's just to kind of pick our brains or if you have something, specific going on and you want our insight in terms of, how we would handle something. If you're a client already, you probably heard a lot of this over and over again, and this might be ad nauseum. Repetition for retention, repetition for retention. We want to make sure that you guys are kind of understanding our philosophy so that this way these moving markets don't feel so scary and they feel like they have a plan around them, which we typically want you to feel warm and fuzzy about. So until next month, well, I'm sure we'll have a lot more headlines to digest. We'll have a new view on where the market is headed because to Sean's point before, we expect there to be volatility moving forward. We don't expect it to be smooth sailing and just straight up to the moon. So we'll see you in June.